G'day, good afternoon, everybody. Welcome to the weekly market analysis session. My name is Carl Capolivo. I'm the market analyst over here at Think Markets Australia. It's a pleasure to be with you as we delve into all the key movements on markets last week and have a look to the week ahead. Let's kick off with cryptocurrency moves, and I have to start and end the week somewhere. So I use Saturday. That's the moves we're seeing on screen, but we have seen some minor weakness in cryptos since then. Still eking out gains for the week, I'd suggest, for the likes of Bitcoin, Dogecoin, Ethereum, Polkadot. A nice move up on Ripple as it continues to bask in the glow of this up and coming SEC settlement. Investors expecting it to go their way. Tron also doing well. That's moving nicely up the DeFi charts. Probably worth a look at that chart also. Missing out Avalanche, Binance Coin, and Cardano. Have a look at the Fear and Greed Index. We're still at 22, which is extreme fear. It's certainly a reflection of the current crypto winter we find ourselves in. That is down from yesterday very slightly and down from last week also. Let's have a look at the charts now. Bitcoin, not a lot going on apart from a little bit of excitement last week as it just eked itself above the key 20,000 US handle. You can see they're topping out at 1450. The Twitterverse got very excited, of course. But like so many pumps, if you could call it a pump, in the recent past, certainly since the start of crypto winter, it didn't get very far at all. We can see we're back beneath that zone now. We are very much in a sideways trend, and without any, substantial narrative to get this going, I can't see us moving out of that sideways trend anytime soon. If we do, though, watch out for a move above 22,793. That would be more than mildly positive, I would suggest, but certainly a move above 25,366. I'm going to say it puts us back into a new Bitcoin bull market. Wouldn't that be nice? To the downside, watch 18,152. If that cracks, then 17,585 is the natural target. Beneath that, there's not a lot holding Bitcoin up until we get to 13.8, a major long-term support level. Looking at Ethereum, very similar to Bitcoin. Again, post-narrative now of the merge, not a lot going on. It doesn't look and feel very much like there's an invisible hand just holding Ethereum down. Bitcoin sort of regaining some of its dominance. The trends are still very much skewed to the downside. That is unfortunate because that promising trend through June, July, August now is a distant memory. If we get below 1218, it looks extremely vulnerable for a move back to test the 1,000 handle and back into triple digits, possibly from there with 880, the only thing holding Ethereum up. The only thing keeping Ethereum from oblivion. Look to the upside, 1422 would be positive, and 1790 is a dream. If there is one crypto in the top 100 I do like, it's Quant, which is getting a little bit of press. So there's a bit of narrative here. They are presenting on October 13 at the big conference, the CBOE conference, which is there's a bunch of big financial institutions get together and chat about payment systems, among other things. And Quant is seen as potentially a solution in that payments side of things for big financial institutions to communicate via the blockchain, but still retain a lot of their personal private information. So very interesting, getting a little bit of press. How long that press can continue to pump the price, that's yet to be seen, but the trends are intact. I think that's the key message here. Short-term uptrend, and the fact that we have pushed above this long-term trend ribbon. I was going to call it a downtrend ribbon. It certainly was, but I do believe once you get above these, they come back, they test, they hold, and head back up again. We start to call that now a long-term uptrend. So it is really the only one you'd want to worry about that's in a long-term uptrend in the crypto top 100. So I'm happy to continue a buy on that one. I've had buying it for a little while. I'm happy to stick that way. Otherwise, Stellar, I think, looks very interesting. XDC also is worth a look, and Ripple, we discussed that one earlier, would be the three others I would say are still in fairly solid short-term uptrends, not yet in long-term uptrends. Bring it back to equities. It was a good week at the start of the week for equities, a tough day on Friday, reversing much of the gains there in the US. We can see still escaping with somewhere between sort of 0.73% on the NASDAQ up to about 2% on the Dow Jones, but about 3% off markets on Friday. That not reflected yet in Asian trading. And these numbers, of course, markets have opened sharply lower today. The FTSE, DAX and French markets underperforming and getting a little bit of the downturn from Friday before they closed, and US markets continued. Volatility, I think, is trending higher now, and that is concerning. After peaking at 34.88 during the week, it sort of pulled back a little, and that candle there, lower shadow, indicating upward momentum coming back in. Otherwise, yeah, look, it's largely range bound over the last few months. A break above 38.94 would spell disaster, I'd suggest. For equities markets, talking about equities markets, let's have a look at the S&P 500 here. It is continuing to trend lower in this long-term downtrend. Short-term trend is down. You can see just how accurate that short-term trend zone there, the light pink zone, was at impeding upward price movement. It is what I call dynamic resistance. A couple of upper shadows, and then the big black candle from Friday. There is demand in the system, though, from the 2nd of September 2020 high at 35.88. It's holding for now, and I don't think we can get too far ahead of ourselves until we close beneath it. That is, ahead of ourselves in terms of, painting a further bearish picture. Look, no doubt we are in a bear market. No doubt the trends are down, and this becomes a very key area of support. Finding that, again, looking like a little bit lights out. For US equities, time to buy, reasons to buy. No, I can't see any at all at this point in time. And it could be a very long time, given the way trends change, the time it takes for trends to change before I would tell you to buy anything at all. So I retain this idea that cash levels must be very, very high at this point in time. And if we are going to be long, that's okay. Small amounts on the best bottom left, top right charts you can find. And shorts, probably skewing more towards those, but again, on the best top left, bottom right charts we can find. And just in terms of how trends change, you can see here how well the long-term trend ribbon dictated price action to the upside. But once we broke beneath it, it really... this idea of trying to find that bottom of the bear market, it just becomes quite silly, really, doesn't it? Very much a bear market here on the NASDAQ. Probably, to be fair, looks worse than the S&P 500, and it is closer, I think, to that key level at 10,565, which must hold to give us any hope of another bear market rally. Otherwise, beneath that, it's not looking good until we get into the 9,000s. And again, we're just reiterating, the trend is your friend. The trend is certainly a friend on iron ore, and we're using this as a bit of a proxy for commodity prices, or industrial commodities more specifically, because there are other commodities out there that are going up. But this is a bit of an indication of what what investors are feeling about global economic growth going forward. So obviously, if we've got strong growth, there's high demand for iron ore, which is used in steel making, which is used in construction. We tend to do more of that when economic times are good, and we tend to use a lot of nickel in that process. And nickel was up during the week, as was aluminium. And the key one here, I would suggest, though, is, along with iron ore, is copper, and that was down for the week. So that didn't get much of the love here. A lot of this love came earlier in the week on the basis of quite a sharp pullback in the US dollar, which facilitated a bit of a rally in these markets because they are priced in US dollars. But I think the reality started to set in towards the end of the week. Coke and coal is another one of those key industrial commodities. It is, again, used in the production of steel, and that's actually did pretty well last week. So nothing too sinister there. However, obviously noting that the long-term trend, I do feel, is very much down on this one. Having a look at copper, I said this is a key market here. This is, then there's a reason why they call it Dr. Copper. It is one of those great indicators of global growth, the health thereof or the lack thereof. And it did turn down very sharply there on Thursday, and that was followed through on Friday. And this is all happening within a well-established short and long-term downtrend. So a bit like the NASDAQ, a bit like S&P 500, we're very much risk on. There's the nickel rally. It was quite modest in the scheme of things. That is still a largely depressed price chart as well. Gold, not an industrial metal, very much moving on the ebb and flow of the US dollar and interest rates. It doesn't like it when there's a strong dollar. It doesn't like it when interest rates are up because it doesn't have a yield. I would suggest that this rally from 1613 to 1730 is significant, however, and therefore until I see us sort of maybe get below, say, 1680 again, but certainly below 1613, I think you just take more of a neutral stance to gold. Just get what I said there, neutral stance. This is far from being a long, in my opinion, but happy to go more neutral on gold. Having looked at some of the other key markets globally, their big move up in crude oil, both West Texas crude and Brent crude. We do have some troubles, obviously, in the Gulf after the Hurricane Ian went through there, and that's possibly impacting prices at the moment. And that rally last week, I do think is substantial, similar to gold. I'm yet to call, say, the bottom of this little bear run here, but it is constructive, and I will certainly be keeping an eye on that, certainly moving back to a more neutral stance on crude oil as well. My gut is, whereas the gold rally might not have legs, I think this one will have some legs, and that, again, also is another possible key negative for stocks going forward. The Australian dollar was weaker amongst the rest of the majors there against the US dollar, which broadly rallied, and bond yields were higher as bond prices continued to come down. Having looked at some of the other key commodities from around the world, kicking off with some of those energy commodities. So one of the key narratives at the moment in markets is this potential of a Northern Hemisphere energy crunch. I'm not seeing it in the charts. Certainly, that was the narrative through here. And I think the market is telling you that for now, that narrative is going very, very cold. No pun intended. Pun intended here. Waiting for it to fire up. Again, we would need to see it move certainly above 719, but I reckon even above an 813 to give it that sort of crude oil sort of move. But interesting to see crude oil pop up and natural gas not follow. I think that's showing a bit of a negative there for natural gas, and also falling in Europe as well would indicate for now that this idea of the energy crunch is hardly looming. That can change very quickly, and obviously the charts will tell us. It's also being reflected in weaker thermal coal prices, but the trend's still broadly higher there. Trend certainly higher on the US dollar index. We did see the big sell-off here. Some of that was to do with our own Reserve Bank of Australia deciding to taper their interest rate increases. Interesting to see those, or the ripples from that reverberate around the world. But I think the reality set in towards the end there that, the economy and demand factors are still quite strong for the US economy, and the Federal Reserve there will continue to increase interest rates. We have seen some significant weakness in risk on markets. The Australian dollar is certainly the pin-up of risk on markets. And when you see the Australian dollar literally falling off a cliff like that towards the end there, it is never a good sign for global growth going forward. And it is there is no coincidence that we saw the S&P 500, the NASDAQ, look so weak when you've got such a key indicator like this, top left, bottom right, and my analysis would suggest nothing but shorting this one. There's no indication in the candles there, the price action or the trends that this should go up anytime soon. Now, anything can happen, of course, but the balance of probability still lies with that going further down. This one here is quite interesting. Australian yields, so higher bond yields generally hurt stocks, and that's what we've seen over the course of 2022. Maybe a double top here forming potentially, still yet to be seen. Short-term trends are up, long-term trends are up, but we'll be watching for signs of lower peaks coming in and potentially more demand for bonds, because that's what we're looking at here. In the US, the yields are still very much skewed to the upside, and just reiterating that idea that higher rates do hurt stocks. At some stage, I do believe that these yields are going to come down very fast and very far as the world starts to realize that the recession is going to bite a little bit harder than some expect at the moment. And that won't be good for stocks either. Certainly this chart isn't good for stocks. So what we're looking at here is the US Treasury yield curve. So shorter yields over this side, longer yields over this side. Typically what we expect is sort of a bottom left, top right look to yields, because that's compensating investors for the time value of money. Obviously you want to get paid more the longer you lock your money away for, and that's what we're doing with bonds. That's what we're looking at the yield curve of, ultimately bonds. What we don't want to see is the other scenario where you've got top left, bottom right inverted yield curve that has historically been extremely accurate at predicting recessions. We're not officially in one. I don't think it'll be long before the powers that be declare one. However, what we also don't want to see is this orange line continuing to be higher than the blue line, and it has been consistently for about 5 or 6 weeks now in a row, just indicating that rates are going up and the yield curve continues to invert. And that is not good stuff. Part of the problem is you're getting higher yields, but we did actually have some weaker economic data during the week for the US. So we're looking at the JOLTS August data. So this is job openings in the USA. We saw 1 million fewer openings, approximately 10% decline in available jobs. There's still about 1.7 jobs available, though, for every US worker looking for work, but that is still not great. It's the biggest 1 month decline since the pandemic was starting to grip markets. Highs and quits were both up. I think that they're both fairly positive, to be fair. Highs are up, that's positive. Quits are up. You only got to quit if you've pretty comfortable in your position and finding a new job. So yeah, maybe a little bit of a contrast there in some of that information, but the key data point there, I think, is that big fall in the job openings. And it is important because it's a closely watched data point for the Fed. The Fed will also watch closely the data points on screen. So we've had the US non-farm payrolls come out, 263,000. This was the reason for the big fall on Friday. Whereas the JOLTS was sort of bad news is good news. Bad news being economy slowing, Fed can slow down. We got a much higher than expected non-farm payroll print, 263 versus the market's expectation of 200,000, which means, again, the economy is better than expected. Technically, that's good news, but it's bad news for investors who wanted interest rates to come down. So we're in this really weird, perverse sort of bad news is good news is bad news environment. And that's really when markets get really volatile and really sketchy. So, you know, that's just an indication of how careful you need to be. The unemployment rate also falling to 3.5% as the participation rate just edged a little bit lower. I mentioned the RBA interest rate decision earlier on. It was big. I mean, it's pretty rare that the world looks at what the RBA is doing, but they were certainly looking this week because as central banks all over the globe are maintaining their rate of increases, in some cases accelerating their rate of increases, the Reserve Bank is the first, I believe, to get out there and start to taper off those increases, increasing rates by 25 basis points or 0.25%. And that was less than what the market was expecting. The market was factoring in probably about 40 or 50 basis point move. I was expecting 40. So, it was a massive surprise. I don't understate the massiveness of the surprise because whilst it doesn't sound like much, I mean, 25 basis points versus 40 or 50, I mean, as little as 15 basis points difference. What happened in the market was far more significant. So the terminal or peak for this tightening cycle at the RBA fell from 4.5% before the meeting to 3.5% post-meeting. So the market is effectively factoring in a 100 basis point rate cut from their previous expectations. And that is a big deal. Now, the Reserve Bank, in explaining why they went slower than many were expecting, said that it is still a very uncertain outlook for the global economy. It has deteriorated recently. Another factor is that Australian households probably haven't yet responded to tighter financial conditions. The full effects of higher interest rates are yet to be felt in mortgage repayments, and consumer confidence has also fallen and housing prices are declining. Now, all of that sounds pretty terrible, doesn't it? So on one side of the ledger, you've got, well, that's terrible. Why are stocks going up? And then you've got, well, 100 basis point, sort of decrease in market expectations of rates. And that's really outweighing the terribles and explaining why we had this huge rally. Look at that massive Tuesday, obviously on the meeting announcement, and then Wednesday following through. Look, Thursday very quiet, Friday pulling back a little, and obviously we're coming back down today. So this is Monday. Monday's halfway through Monday session as I'm talking to you, and we're trading in the 66 area, 66.50 off the top of my head. And it is taking some of the gloss, about 1.5% off some of these moves from last week. But for what it's worth, I think it was a very solid performance, whether you think it was for the right or the wrong reasons. Energy, the standout there. Obviously, we saw crude oil prices soaring. That was up 10%. Gold getting a bounce. Again, we saw gold prices rally. Materials still pretty strong. We did see strong materials there, and infotech getting a bit of a pop. It is a key risk-on sector. Property trust bouncing back. They've had a tough time, but you can see really underperforming the broader market, as did the discretionary stocks as well. So that's interesting there. Telecoms probably bringing up the rear utilities. Not a bad bounce at all. Having a look at the technical analysis factors here. So the first one is the market breadth. So how many stocks are participating in the rally? And we're looking at stocks trading above their 5-period moving averages all the way out to their 230-period moving averages. That's getting up to about a year. So how many stocks are above their 1-year trends? Fewer than 30%. So around about a quarter of them. That means 3/4 of stocks are trading beneath their 1-year trends. That is bearish. That is a bear market. In the short term, though, because of the bounce last week, the majority of stocks are trading above their 1-week trends, but it does fall away very quickly from there. The bottom line is, if we're in the green zone, that is where we are in the healthy bull market. So healthy bull market, you're more like 3/4 of stocks in uptrends and pretty much flat across the board. That is a healthy bull market. A bear market is very much down around the red zone and pretty much where we were last week, to be fair. But some improvement noted, some improvement here also. Looking at the technical analysis trends on the ASX sectors, we can see that the Aussie trend moved back to neutral because of that rally. But still the long-term trend is down. Discretionary is still down. Again, you want to avoid, I think, you want to avoid the double reds. You want to still embrace the double greens. That would be energy and energy alone, and not mess with anything in between, which is, for example, financials, which did get a bounce. Gold, we know, got a bounce. Materials got a bounce. But healthcare, despite that bounce last week, still very much down, as is information technology, property, staples, telecoms, and utilities. So pretty slim pickings, I think, to look out for this week, but market is getting cheaper. I mean, we can see there the S&P ASX 200 1-year forward PE. So this is using, about 15 or 16 broker estimates, and brokers from research houses all over the world give their estimates to Thomson Reuters, which is where I get started from. And it is a week in arrears, though. Okay, so it is mainly reflecting the falls from the week before and not yet the rally. But for what it's worth, getting quite cheap in terms of long-term averages, which is around about 15, and certainly way down from the COVID peak. Sectors that look very cheap, energy. So it's nice when you've got a nice chart there and stocks that are still relatively cheap, but they are cycling some commodity price bumps there in energy and materials. The ones which aren't cycling, earnings bumps and are starting to look cheap, I'd say property trusts. That sector trend's still terrible, but it's starting to get cheap. So, if you're that way inclined, with keeping an eye on, utilities are probably on the right side of cheap. Information technology is getting closer to fair value, not cheap, but closer to fair value. That's interesting. Financials probably on the right side of cheap, and discretionary maybe just squeaking in there as well. In terms of upcoming events this week, I was going to say pretty quiet, and it is pretty quiet. The major bits of data coming out Tuesday: Westpac Consumer Sentiment Survey and business confidence. They're getting readers on how the consumer and businesses are feeling right now. So any further deterioration there will be watched with extreme interest this week, hands down, without a doubt. Going to be the inflation data coming out in the US. So we've got wholesale inflation data coming out on Wednesday night Sydney time, 11:30 p.m. Sydney time. We're expecting a 0.2% on the headline, 0.3% on the core, and those readings up on the headline, slightly down on the core. And then we've got the consumer inflation coming out there on Thursday at the same time, 11:30 p.m. Sydney time. And we're expecting a slight increase on the headline to 0.2% and a slight decrease on the core there, 2.4% year on year. It'll be 8.1 for the headline versus 8.3 previously. Then we're going to get some Chinese inflation data on Friday, and closing out the week, some closely watched data, I would suggest, on retail sales and consumer sentiment. Well, that's it for this session. If you want more analysis, plenty of charting, plenty of fundamental analysis, how to value companies, but you get to ask the questions, head to that link there, www.thinkmarkets.com/au/learn-to-trade/webinars. It's a long one, but you'll figure it out. And register for my Ask the Experts webinar. It is free to join. I'll answer your questions live, in real time, streaming all major markets, anything you want to get a fundamental or technical reader on, and plenty of education as well. We do it every Tuesday at 1 p.m. Australian Eastern Daylight Saving Time. If you are trading, you need to know about Think Markets and the Think Markets offering, because we do have world's best practice platform and services, over 3,100 shares and ETFs. If you're trading shares, $8 flat rate trade, CHESS sponsored, very important for your self-managed super fund. And you can, with us, have your self-managed super fund in one account, and in another account be trading over 4,000 CFD products on FX, indices, commodities, futures, crypto, and shares. So if you saw any of those charts today on those commodities you'd like to take a view on, probably short on many of them, maybe long on crude oil, you can certainly do that with us at the same time as trading your shares as well. A market-leading spreads, commission-free on CFD shares, very important. Award-winning broker, we haven't been around for 5 minutes, we've been around for a long time. We have some fantastic platforms, many platforms for you to use, depending on your requirements. World-class trading apps, dedicated account manager with 24/7 customer support. We are regulated in a number of jurisdictions around the world. Global entity is Think Markets. Locally here, we're based in Melbourne, and we are regulated by ASIC, the Australian Securities and Investment Commission. If you're watching me on YouTube, make sure you hit the subscribe button to stay notified of any of our future updates and analysis, and make sure you hit the like button to let me know you like what I'm doing, so I'll continue to do more of it. It has been a pleasure chatting with you today. All the best for your trading and investing. Till we catch up again. Bye-bye for now.